What up, Pod Squatters? I'm Anita Wong.
And I'm Tiffany Lee.
We're investors, real estate agents, and the co-hosts of SARE Ladies, the girl power arm of subtle Asian real estate.
Every episode will feature funny, casual conversations with dope AF participants killing it in the real estate game. But also mostly people like you and me, just trying to figure it out. Stay for the drama and lulls. We're not pulling any punches. But first, a word from one of our fabulous sponsors.
Hey, SARE Ladies listeners, Tony the CPA Dude here, also your resident SARE Tax Bro. And with your lovely host, they came up with some great ideas. So Miss Tiffany and Miss Anita here came up with the tax workout plan. So we're gonna help you get cut up on your taxes, also gonna help you cut up on your own body. So just like working out, taxes is a monthly thing. You can't ignore it, otherwise you're gonna fall off the cliff. So with the code SARE Ladies, we're gonna give you a nice healthy discount, and we're also gonna give the SARE Ladies a kickback just to help support their podcast. I've had a fun time being on their podcast a couple times this year. They've done great. I really want to see them blow up in 2023. So with your support with this creative tax workout plan and also a workout plan in general, we're gonna help you transform your life in 2023. So mention the code SARE Ladies when you talk to me. You can email me at Tony@the CPA Dude. Text me at 928-CPA-Dude. TikTok's the CPA Dude. Website's the CPADude.com. Everything's the CPA Dude. So SARE Ladies is your special code here, and let's make this year great.
Now on to the show.
Hey, Pod Squatters. Welcome to the SARE Ladies podcast. This is your host, Anita Wong and Tiffany Lee. Today, we have someone really special for you on our podcast. So as you know from our last episode, CSSI or cost segregation is a really big topic this year. And if you don't know what that is, or you should know about it. So I've brought my personal cost segregation expert, Bonnie Kaake, coming to you from Denver, Colorado. Say hi, Bonnie.
Hi, ladies. So good to be on your recording.
Yes. I love it. Bonnie, you're so sweet. Okay.
Let's see if we can save more people money.
Yeah.
Yes, absolutely. So funny story about how I met Bonnie, actually. We were at the Best Ever conference earlier this year. And for those that don't know what BEC is, it's a big conference hosted by Joe Fairless, and who wrote the book on the Best Ever Real Estate Syndication book. Anyway, we were at the whole conference was shuttled to this bar in downtown Denver. And at that exact moment, I was like freezing and I wanted to go home. And then Bonnie was standing there also freezing, wanting to go back to the hotel. And we just commiserated. And then on that bus ride, we met, and then, we talked about her family, which we had a whole conversation about that. How many siblings do you have, Bonnie?
10.
10.
Wow. Like, wow. Where are you in the 10? Where are you?
I'm actually, well, it's kind of a long story, but I'm the oldest of the 9. We found a new family member, half sister, about 7 years ago.
Oh my God!
We're 2 peas in a pod. I mean, we our husbands and we have traveled together. I'm closer to her than the rest of my siblings, even. So, you just never know.
Because I guess you guys are probably closer in age, right? So if you're the first of the 9, and then there's the first of 9, so you're like 2, and you 1 and 2 probably.
She's 3 months older than I am.
Oh, okay. Oh.
Yeah.
We don't have time to go into all of that.
I think the way
on the Sarah Lee's podcast.
I think the way that she presented it to me, she's like, I have 9 siblings, but I recently had a 10th one. I was like, what? I think I was so confused. But anyway, it was such a fun bus ride, and it was like we were just shivering on the way home, back to the hotel, I mean. And then, she told me about CSSI, and I didn't know at that time that you could, it was my personal thought that you could only do CSSIs on commercial properties, like I thought like industrial properties, offices or whatever. But she told me that I could do one on the multifamily that I just bought. And then now she's doing another one on my my STR in Dallas. So Bonnie, do you know how much to date that you've helped me gain through COSSEG? Do you have that number?
I do.
What
I do.
what
I'm a
what is
numbers
what is
person.
yes, what is it? What is it to date? Just to
Well,
see
with COSSEG, we were able to get you instead of 25,000 in deductions for 2020, I think it is. We were able to give you another 180 or actually $185,000 in depreciation expenses.
that's
So
awesome.
in reality, the bottom line is you have about $39,000 worth of taxes you don't have to pay.
Wow.
And that's just
she
on
made
some
that
property.
You're like
Yeah.
her fairy godmother. You're the
Yes.
COSSEG fairy godmother.
Where are my wings?
Love that. Oh my god, I love you. I know
I really want to
Bonnie
say hello.
Bonnie made that conference for me. She was like, "Well, I spent money on this conference, but I immediately just got it back on this bus ride." So
That's true.
right? Worth it. Worth the whole
Yeah.
thing. All right.
That
Well,
was great.
All right. So welcome, Bonnie. You're awesome. So, and Bonnie is basically Anita's cost segregation fairy godmother. All right, so for those of you that don't know Bonnie Cake, which we talked earlier, she's like, my name's pronounced like birthday cake. But I was like, I'm gonna accidentally call you birthday cake on the intro. But for those of you that don't know Bonnie Cake, Bonnie is a national account executive with Cost Segregation Services, Inc., which is CSI, like crime scene investigation, CSSI for short. And she's an expert in the areas of cost seg and tangible property regulations. She helps commercial building owners increase their cash flow and tax benefits. CSSI partners with CPAs, tax professionals, commercial real estate agents, and real estate attorneys in all 50 states. Bonnie Cake keeps them up with the latest regulations through CPE. CPE, what does that stand for, Bonnie? CPE classes.
CPE is oh my god, it's ridiculous. Continuing professional education.
There you go.
And it's
Continuing
for
professional
CPA.
education.
Yeah, CPAs have
Love
to have so many credits every 2 years. And so yeah, usually in the fall is when we do them. Some are done by our corporate office, and I actually do them with the Colorado Society of CPAs, and online or luncheon learns, that sort of thing.
That's awesome. So excuse my ignorance here, because I'm not a tax expert by any means. So is cost segregation a subset of being a CPA? So are you a CPA and then you specialize in cost segregation? Is that how that works?
No, I'm not a CPA.
Okay.
I just like numbers, I guess I should say. And I like helping people. And I've always been a technical guru, I guess I would say. Though marketing is was my degrees in marketing. And I also have a real estate broker's license that's inactive.
Okay. Wow, you're all over the map. Love it.
Yeah, I've invested in commercial real estate. Have one rental property now that's a midterm rental. And I love that. So,
awesome.
Experience in the area and love it.
Love it. Okay. Yeah. Sorry for that sidebar within your introduction, but that like sparked something in me. So Bonnie, she keeps everyone up, keeps the professionals up with their continuing professional education classes and webinars. Bonnie's focus is getting more money for commercial property owners while keeping them audit proof. So let's jump into the first question. Basics. What is cost segregation and why should people know about it?
Well, a lot of people are looking for loans to do rehabilitation or rehabs on their properties. And a lot of times they don't know they can actually look at their own property right now. Because what this is like a free loan from the IRS. That even when you sell the property, you may not even have to pay any of it back. But sometimes you will have recapture. But the recapture is at how would I say it? It's at your normal tax rate, your standard tax rate. But you can mitigate that, or I should say your CPA or tax professional mitigates it, because the things that we depreciated up front aren't worth the same when you go to sell the property. So instead of being recaptured at your marginal tax rate, what it's going to get recaptured at is actually at a your like the 20% tax rate for other things that, boy, come on, I can't think of the term now. It's crazy. It's at the lower tax rate, like you would on stocks, bonds, that sort of thing. And so it's, it really helps in that regard. And some things can just be expensed off of your depreciation schedule even before you sell the property. That's another thing people don't think about, and it's very difficult. Tax professionals, they don't do it. There's 3,000 pages in the tangible property regulations alone. So if they're not doing nothing, but commercial real estate work, they're not going to be up to date on that. Matter of fact, there are very few people in the country that actually can do those tangible property regulations updates on a depreciation schedule.
That's great. So you're basically like an extra team member on a commercial real estate investors team, and you work in tandem with the CPA to give them advice on what to deduct, because that's just another can of worms. It sounds like that has all these nuances and rules that I guess a general CPA isn't aware of. So is that what happens? Like you generate a report and then you give it to the CPA as like an extra addendum to include when they file their taxes?
Yes, the report that we give is free of charge. The initial, anyway, the pre-analysis, and it's pretty accurate. Usually, it's within 10% plus or minus of what you'll actually receive, and ours tend to be on the conservative side because a lot of our tax professionals, what they'll do is they use that before the study's actually done to estimate quarterlies for the client going forward. Because you may not have to pay any quarterlies if you've been paying them with cost segregation done. And the word I was trying to think of is capital gains rate, which is always lower.
Excellent answer. So to give you some background on a lot of our listeners, they are investors who not only invest in commercial real estate. That's kind of like the big leagues, right? It's commercial real estate. A lot of our listeners are starting off, or they're intermediate investors. So I think an interesting question that I think would serve them is, what kind of properties can you take a cost segregation for? Like, for instance, can you cost segregate a condo?
Yes, you can. As a matter of fact, a condo, a single family residence, any rental property, it can be cost segged. And a lot of people don't realize that. Of course, sometimes it doesn't make sense to do it. And that's usually if the property is under a purchase price of about $200,000. Yet on the other hand, I had a client come to me who bought 8 condos in a fire sale, all under $100,000. And he said, they're in the same building. Can we cost seg these? And what we did is we grouped all 8 of them together so that it would qualify for us. And we were able to do them all together and at the same time. So that's
awesome.
That was another way of doing it. But just a single condo at $100,000 probably isn't big enough to do. But think about this. A condo rarely has much in the way of land. So it actually increases the tangible property that can be depreciated up front. So
I love it.
People,
go ahead, Marie. Sorry, I kept interrupting you. I apologize. What were you going to say? Finish your thought, please.
Okay. What a lot of people don't realize is that the single families and even short-term rentals can generate a lot of tax deductions and cash flow because you don't have to pay all these taxes. just like Anita's got another $39,000 to play with. We're finding more and more people, actually, about 30%, 25 to 30% of all single family homes in this last year were purchased by investors. Because the prices are so high, it's difficult for a first-time homeowner to go in and buy something now. And so they're being purchased by investors and then rented back to, people to occupy those properties. Another thing is, the short-term rentals. I've got a guy that has a single-family property, and he's very young, is getting married soon, and he contacted me and said, I'm living in the basement, and I do short-term rentals in the rest of the house. Can I do cost segregation? Yeah, we can. We just have to subtract the square footage that he's using, and the rest of the house can be depreciated just like any commercial property would be. Only his short-term rental is 39 years. We get a lot of depreciation schedules that are done incorrectly, and short-term rentals have to be 39 depreciation schedules, 39 years. And so many of them come in at 27 and a half. And I'd be a little concerned about the IRS because they're looking for low-hanging fruit right now. And a short-term rental depreciated over 27 and a half years could be a target.
I see. So what I love about your answers is that, you're so, you have an understanding of what the investor's like strategy, what the client's like portfolio and strategy is. So I do you think that, in your role, do you feel like you're more creative or logical about how you approach a appropriate cost segregation strategy?
Well, most of my life I've worked with engineers who are not really marketing oriented. So my approach has been creative with the details and keeping it legal. But I want to look at what opportunities are available for people that your CPA is not thinking about. They're not thinking about strategy. It's not their job. And right now there is such a shortage of CPAs and accounting professionals in the country. They don't have time to research the details of someone who owns commercial property even down at that level of a single family home or condo to give you the answers. So what I'm finding is a lot of people that contact me are outgrowing their tax professionals. And the tax professionals know that, but I can also educate your tax professional and help them get up to speed so that they can increase their business if they choose to do that or have the time even to do it. But I'm doing seminars for real estate investors quite frequently lately because too much of it's not known and they're leaving money on the table. I don't like that.
I love that. You're blowing my mind right now, Bonnie. So what's funny is you mentioned that you work with a lot of engineers, and I went to an engineering college. Like, little known fact about me, it's and you're right, they are they're not marketing, or it's a whole different personality type. They're not marketing oriented at all. I don't even know if they can hold a normal conversation with human beings. There's like a lot of numbers. Yeah. But they're so process oriented, right? So can you take us through what the general process of the cost seg would be, and what would be the cost to do one for a short-term rental investment, a multifamily investment, etc.? Like, how long does the whole process generally take, especially when tax season is approaching?
Oh my, yes. Right now, we can still get them done for March, but I have to have not only the estimate out to the prospective client, but also they have to agree to go forward. Half of it's up front, payments up front, the balance when the study's complete, and all the documents that we need, which are usually things like appraisals, floor plans or blueprints if you have those, previous depreciation schedules if the property's been owned for more than a year. That sort of thing we turn in with the signed agreement, and then we send somebody out, because ours are all engineering-based studies, and that is the IRS's preferred methodology, which means that when you go to do a study on that property, you also have to be on site and review indoors as well as outdoors, because there are a lot of things that are missed if you don't go inside the property as well. I think a perfect example of that is you can depreciate hardwood floors, you can depreciate vinyl floors all up front, and carpeting. But if you've got tile floors, which a lot of people are putting into bathrooms now, and depending on where you are, there are more and more people putting tile in. Tile is a long-term capitalized asset. So if you don't go inside the property, you don't know that. Okay, so there are a lot of people doing what they call desktop cost seg studies to keep the prices low. And I personally, if it was my property, I'd want a real thorough study, an engineering-based study.
I find that so interesting, right? Because it almost seems like if people knew these rules ahead of time, it might even influence their design decisions for what materials they use to improve their properties, right? And
Right.
Because I feel like people work with the aesthetics first, but if they knew what tax benefits are there, it almost gives you another layer of rules to be creative around. So I think that's so fascinating to me. So great answer, Anita.
I'm curious, like, okay, so tiles, like, so other than that, what kind of like design things that people don't know about, like material wise, like if they're doing like rehab or something, like what would Bonnie put like in her like, say like her multifamily home, what kind of materials would you use to optimize your cost seg?
I love that. Yeah, what's the optimal? She's like,
Yeah.
Asking for a friend.
Yeah. Well, if it's very, very high-end property out on the beach in California or something, I'd probably put in high-end materials, whether it can be cost segged or not. But if you have a multifamily that, you're not expecting, people that have, $1 million to spend on a single family rental, I would probably do the high commercial grade vinyl, the planks, and that are they're wonderful because they can also be depreciated, and they look so good nowadays. They really do.
Yeah, luxury vinyl, like luxury vinyl, right?
Yes,
yeah, they're really nice now.
They really look so good, and they're so easy to keep clean.
Mm-hmm.
And of course there are some downsides. They're going to wear out faster, and you can't refinish them like you would hardwood. But for maintenance and a multifamily, I don't think you can beat them.
That's so interesting. Wait, oh my gosh, here's another layer to that. You just mentioned that they don't last, the vinyl flooring doesn't last very long, right? So if you replace it again, is that another cost segregation, like tax event that you can then do recurringly? Are you getting too creative here? What'd you say, Bonnie?
Actually, you can write the one off your depreciation schedule that you're pulling out because it's gone. Okay. And when you put the new one in, because it's a repair, you can expense that.
Boom. There's a little nuance, the little value add spot street. That's the poker brain going on.
Oh, yeah. Well, and another thing that I tell people is that, sometimes, depending upon your tax bracket, what you can write off and what you can't. Usually anything that's a $2,500 bill, you can write off anyway, okay, as an expense. A lot of times you'll replace part of the carpeting or part of something, and maybe the bill comes to $3,000, $4,000. I tell them break it up into material invoice and a labor invoice. If they both come under $2,500, you could expense both.
Ooh, so you play within that 2,500 boundary too. Oh my God, these
really,
rules
it's
are so
legal.
creative. It's so fun.
Ooh,
Yeah.
that's so many
Ooh,
ideas now.
all right, so we talked about flooring. What would you suggest for countertops?
Well, I really like I like granite. I think it's very durable. On the other hand, you do have to seal it on more of a regular basis. The new countertop materials can be a little more expensive, but they actually are more durable in that if somebody puts a hot pan on top of it, well, you don't have to worry about that either with granite. But what's the other type here?
Quartz.
Quartz. That's it. Got it. Quartz is an excellent countertop. Now, if you want to be replacing them on a regular basis, which is going to happen if you use something different than that, that's fine if you're really cutting costs to start with. But just realize that it's not going to last as long. The first hot pan they set on it, gone.
Okay.
So I've seen a lot of them, even the rental properties putting quartz countertops or granite countertops to prevent that, having to redo it. But it depends on, which class property you have. Do you have a multifamily that's A or C, or, what kind of building is it? You have to make some determinations there.
So the answer is it depends, right? It depends on a bunch of factors.
I say that all the time, and I hate doing it because I know people don't like saying it depends. Give me an answer, right?
We have our friend Annie Lou, who is she obviously a lot of people know her in SARE. She runs there. Anyway, she's like, I'm about to write a book on real estate advice, and the title is going to be called "It Depends." That's so funny.
So true. It's just like Tiffany asked earlier, okay, what's the price on this one, or what's the cost to do a study on that? And I have to say it depends, because let me give you just one example, okay? Normally across the country, a warehouse has about 20% office build out, and the rest is this big open space. Obviously, it's the open space. It probably has overhead heaters, and it's probably concrete floors, no walls, and you've got all this office spaces, about 20% of it. Well, if I don't ask what percentage is office space, and I find out that maybe they've got a little space in the back that's a drive-in door, but it's 60% office, there's a big difference in the amount of work that we have to do. So, that's why, there are a lot more questions than just, okay, what's the cost of the study for a single family home? I've had single family homes on the coast in California that the land is almost as much as the house because of the location. And the same thing happens in major cities where the land is really high. I've had one here in Denver that I'll never forget this one. The owner calls me and says, I bought this property last year, and I want to do a cost seg on it because I understand that's really a benefit. Well, I looked up the land value. The land value said it was 99.9% land. This poor guy says, how can I do a cost seg? I said, well, right now you can't. But what I recommended is that he go get an appraisal on the land only. He did that. It came back at 30% land value. So then we were able to do the cost seg. The kicker on this was that there's an operating restaurant on that land that's been there for years. So it's like it can't be 99% land, though downtown area is just booming. And so the land values are going through the roof. So sometimes you have to be a little creative and say, well, wait a minute. Now, why is this? And that helps everybody in the process. Because if I just left it at, well, we can't do it on that, it's 99% land, he wouldn't have had the benefit. And this was a multi-million-dollar property.
Hey, we're going to take a little break, but in the meantime, here's a shameless plug for one of our amazing sponsors. Dr. Hua Win and her husband, Dr. Jaime Gonzalez, both optometrists by trade and owners of multiple multi-million-dollar optometry practices in the Dallas area, founded Black Steel Investment Group with a passion to invest to impact. With the foundation forged on 3 pillars, integrity, community, and legacy, they put their investors at the forefront of everything they do. The couple are both seasoned, full-time, multifamily investors, syndicators, and asset managers who, together with their investors, have invested in over 6,900 units as general and/or limited partners in Texas, Arizona, Florida, and the Carolinas, with total assets valued at over $480 million. Juan and Jaime are always working to find new investment opportunities for their investors. The couple enjoys traveling the world for delicious food and interesting cultures with their 8-year-old daughter Athena and have a puppy named Coco Ollie. I love that. So you do a deep dive and just do a deep clean on the property and just find you need to take that consultative approach. And I think that drives the point home that you need to bring in an expert to kind of see what you're missing, right? Because you don't know what you don't know. And I think a lot of people, tax season can be very overwhelming, and just bringing someone like you on board who's a cost segregation expert, Bonnie, it's just an amazing weapon to have in their arsenal.
Yeah. And these are not cookie cutters. I mean, you don't, when someone comes in and says, well, what's it going to cost me to do this on this, and they don't give me enough detail, I can't really come up with a reliable number for them. And it's nice for when people get a pre-analysis or estimate in advance. If somebody's really doing a thorough job of it, you can get it very close to what the numbers are going to be. And we're usually a little on the conservative side. And that's because a lot of CPAs and tax professionals use this information to determine whether or not you're going to have to pay quarterlies going into the next year. So we don't really have to have that study done, by the end of the year, which a lot of people are panicking and saying, oh, I got to get it done by, the end of the year. No. If you extend your taxes, you can actually do it mid-2023. Oh. It's just give us enough time to get it done. So we're looking at probably 4 to 6 weeks right now. As we get close to the tax time, we don't miss the dates, but if we're really close, we'll warn you that we may not get it done. Be prepared to extend your taxes.
Yeah, so by the time this comes out, we are not late. I guess is what we're trying to say. With this podcast, it's not coming out late. You still have some time, is what she's saying, and you better give Bonnie a call. Exactly. So I love that you talk about, like there's some, you don't have to rush. Or there's moments where you don't have to do the cost seg. And so at least my next question, when is it not advisable to do a cost seg?
Well, if you don't pay any taxes for some reason, you have enough credits not to pay taxes, or you're a nonprofit, it's not going to help you. Okay. That's pretty much it. Is if you're in a very, very low tax rate and the property is on the low purchase side, it may not be worthwhile. Though I never say never on those. I like to send them in and say, what do you think? It's just like the 8 condos I mentioned earlier, that each of them were $100,000. Sometimes there's a way of getting you help. It just depends. So, it's, call me or send me an email and I'll help go through that. I'll send you a list of questions. If it doesn't look like it's viable, I'll let you know. A lot of people think that someone in their 80s, 90s who's going to will their property to their kids doesn't need cost seg. Well, I got news for you. That's the best time to do cost seg, because if you're going to will it to your kids, if you do cost segregation, you don't have any recapture when you pass. None. Your kids inherit the property at the current market value. they can do a cost seg again. So taking the money now, if you're in your, older years, or who knows, maybe you have cancer and you own all these properties and you know that you're going to will it to your heirs. It's a good time to do it because you can use that money for grandkids' education, medical treatments, pay your housing rather than taxes. And at the end, you don't have to pay anything back.
Wow. Yeah, that's great advice. So for all of you, well, I don't want to say, but you're going to will, if you are inheriting properties, so maybe something to bring up and have that conversation.
Right.
Right.
And of course, there's one other way to avoid the recapture too, and that's doing a 1031 exchange into another property.
Mm-hmm.
And doing that 1031 exchange, are you familiar with what that is, both of you?
I'm in the middle of one right now. Yes.
Okay.
A reverse 1031 exchange, a little saucier version, but it's yes.
Well, with a 1031 exchange, for those that don't know what that is that if you exchange your property for another property, instead of just selling it and paying taxes, you exchange it into another property purchase that's of higher value. You don't have to pay any recapture at all for either the structure that you've depreciated or the tangible property that we depreciate up front. It rolls into the next property. And you can still do another cost seg on the new property for the difference between what you're rolling in and the new property purchase.
Got it. I didn't realize. I knew about the 1031 exchange as a possible, but I didn't know that cost seg would be is another option. That's interesting.
Yeah.
Well, a common question that I always get, or we always get, is when's the best time to do a cost seg? So you buy a property and really need some work. Should they get the work done, or should they do the cost seg first and then do the work?
I know you want to hear this. It depends.
Okay, go ahead, Bonnie.
Okay.
That's what we should title this episode with, Bonnie. It depends. Segregation. It depends.
Okay, here's the detailed answer. Okay, we can do a cost seg on a property once it's occupied. Okay, so if you buy a property today and you do the renovations right away, and it's not occupied, we have to wait until you list it for occupancy before we can do the cost seg. And whatever you did in rehabbing it or changing it in any way, maybe it's a major renovation, whatever you did is going to go toward the capital purchase price of that property, not be able to write it off up front. Okay. If you do it in the second year, let's say you buy the property, you do a minimal amount of work on it, you occupy it, rent it out, do the cost seg, and the next year you decide to renovate. Or you tell me in advance, look, we're putting this much into it next year. I'll give you a quote covering not only the current purchase, but also what those renovations are going to be, and we update the study in the next year. Okay. Another aspect is that if you do the renovations in the year or any year after, you can do what's called partial asset disposition. What that is like, I think the easiest way to explain is probably like a car dealership or a fast food restaurant where it's a franchise. And what they do is the franchisor requires they upgrade the look, the feel, the furnishings, whatever it is in the property on a regular basis. Maybe it's every 5 years. Well, if they don't do what's called partial asset disposition, then they're leaving a lot of money on the table. Because what that is when you buy a building, what's in that building you've paid for. If you're going to tear it out, you've lost that part of what you own. So we can take what you're tearing out has value, and we can remove that from your depreciation schedule as an expense. It's gone. Okay? What you're now putting in is also something that can be either depreciated or it can be expensed, just depending on what it is. It's part of the study. But if you wait a year and then you come and say, well, last year I did this, I took all this stuff out of the property, we can't help you. It has to be done in the same year that you purchased, or not purchased the property, but did the renovations, to be able to take advantage of both sides of that.
Mm.
Is that making sense? Or might need more explanation?
I actually, so in theory, right, I guess, does it make sense to know what that max number is? There a max number that you can cost that? Because I almost feel like, say you have like a rental building, does it make sense to space out the renovations if it's a rental building that you want to upgrade, so that you can take advantage of any cost segregation, I'm going to call it spots, like every year, so that, you know, it's predictable, is like for you know, the upside there? Because I know some rental buildings will have a mix of, you know, renovated units and and you know, just not renovated units. So does it make sense if you're managing that property or managing that investment to kind of space out the renovations to take advantage of any cost segregation advantages?
It can be an advantage, because if you know, like I mentioned a little bit earlier, if you buy the property and you know there are things that have to be done, do what you have to do that year. Then the next year, you want to do more major renovations if you need to. But whenever you do major renovations, you really ought to call your Class Seg expert if they will talk to you, and get some advice about, when should I do this? Because if you owe a lot of taxes in 2023, but you're thinking about doing the renovations in 2024 because you have all these taxes to pay, no, you want to do the reverse. Get them done now so that you can take those off your taxes now. So it just depends. Again.
Awesome.
That's terrible. Another thing you should consider, and I went through this with a very large vet clinic here fairly recently. They had 8 air conditioning units outside their building, and they were considering taking all those and replacing them all, because they totally renovated the entire building. They bought it, major renovation, more even than what they purchased the building for. And she said, well, we really should replace all of these air conditioning units. I said, don't do them all. Do maybe 2 a year. You know, the ones that are in worse condition. Because if you do that, it's 1/3 or 35% of the units, less than 35% of the units, you can expense them. But if you replaced all of them, you're going to have to depreciate those over 39 years. So that is a big difference monetarily and tax-wise. And it's little things like that, you know, it might have been 2 years from now after we had done the cost seg. And if she hadn't contacted me and asked that question or explored the options, she wouldn't know. And I don't need to do a study on that. I just give her that information.
That's so interesting, because I feel like cost, like, there's like a trickle down with the depreciation, right? So if you buy a new AC unit, that's like automatically an expense. But like AC units or any appliances, they also have their own annual depreciation rate, right? That you can write off on a cost seg. So it's like you're taking that little percentage every time, but then when you buy some time how you're replacing something, then you get that little bump on that expense. Am I saying this correctly? Is that the concept you're trying to drive home?
For people who own residential rentals or apartment complexes, this goes back to what I said earlier. If that, let's say 4-plex, the appliances are not in great shape, okay, but you bought them, you paid for them. If you replace those in the first year of ownership, they have to be capitalized. You can't expense them. If you do it in the second year of ownership, then you can expense that replacement.
Can you make an argument for including like an automobile in your cost seg for property? Have you ever done something like that? Because I know cars depreciate all the time, or that's something completely different.
Yeah, that's completely different. That's for your tax professional to deal with.
What if you live in a mobile home? What if you own a mobile home park?
Actually, I've done a lot of those, and also RV parks. You'd be
That's
amazed.
technically an automobile.
You really would be amazed at an RV park or you know, a mobile home park and what the advantage is there. Because a lot of times in an RV park, the people who are leave the mobile home. So that becomes your property. And you can depreciate that right now.
See, we found a little loophole, a little spot there. Yeah, if it's an RV park, technically it's an automobile.
And think about it, they usually have an office on site. Look how much you know, drives you have to put in between the units. You've got electrical, you've got plumbing. All of that is depreciable.
I was thinking about, you know, like when you were talking earlier about like land versus like the building, right? Because there's, and correct me if I'm wrong, the mobile home, the owner owns just the land, right? They don't, so it's almost entirely land and maybe a few offices or utilities or some kind of like amenities, right? Or like, how does that all work? Actually doing a cost seg on a trailer park.
Well, on a trailer park, there are pads, concrete pads that they're usually setting on. Those are all, that's all 15-year property. And with bonus depreciation, let's say in 2022, that can all be taken up front. First year.
That's cool. Anita, we should start. You know how there's that van life trend right now? Maybe we should.
I think we kill each other if we stay in a van together.
No, I'm not saying we stay in a van together. We have a mobile and trailer park and we build out these van homes, because then technically it's a hybrid home / automobile. So you can you in theory write off those automobiles and also write off the land that you're the plot of land that you're camping them on. Is that doing? Am I committing a white collar crime here? I don't know. Bonnie, keep me out of jail. What's happening?
All right, now let's think creatively here, okay? Because if you put a couple in a van and have them live there, they're going to go through a divorce. They're going to buy new properties or rent new properties, right?
Yep.
But you know, that brings me back to another point, right? Because you were talking about end of life reasons to do a cost segregation. So are there any life milestones where top of mind it makes sense to do a cost segregation that might happen? Like, because you just mentioned divorce. Is there any opportunity there to do a cost segregation if they're like, if you know they have to split up their assets? Like, does that create a major tax event? I've never been divorced before, so I don't know, but maybe you've come across this. But yeah, interesting question.
Usually one pays the other one off. Yeah, I could say I've been there. Okay, with commercial property and warehouses. Okay, so one pays the other one the value for the current half the market value of the current property. That's usually what happens. You know, depends on the state you live in and what the title is in and all of that. I mean, there's so many legal things to consider there.
So here's all right. So wait, can I just have one more thing, Anita? So, all right. So if you're getting a divorce and you're the spouse paying the other person off, would you bring in a cost seg expert to get the number down or find a way to get that value down so you pay them less?
No, it's two different things, because one is market value, has nothing to do with what you paid for the property. Is what the property's worth now. That's through a divorce.
Okay. So you can't take anything off the income. Like if it's still an income generating property, is there a little nuance there? Because it's not like, I'm not saying like it's a vacation home that they own together and they don't rent it out, but I'm just saying like if they have, I don't know. whatever. It's opening a can of worms, and we're almost out of time. This is me. Like, Anita hates when I go on these
Are you
tangents, and I
planning
just
a divorce, Tiffany?
Yeah, she's
I'm just trying to advise my
Pre-planning her
clients if they're getting a divorce.
gosh.
Oh
Yeah.
gosh. Well, I've known people who get a divorce and it's a friendly divorce, and they may just take the income and split that. You know, and it's 50-50 ownership of that rental property. But usually the courts will require that you sell the property and divide the proceeds.
Interesting.
Yeah.
Okay.
So before I know we're kind of running out of time, but I want to what should people look out for in the next year in regards to cost seg? So are there new regulations that we should look out for?
Excellent question, Anita, because a lot of people are wondering that, because the bonus depreciation is dropping to 80%. And most people don't know what that really means, bottom line. So what that is that 80% of what we find we can depreciate up front can be taken the first year. Okay. The other 20% it gets expedited, but it's down to 5, 7, and 15 years. So it's not like you're losing all of that depreciation. It's just different timing. Does that make sense to you?
Got it. Okay.
So if I give you, $100,000 in depreciation, 80,000 of that can be taken this year. The other 20,000 would be spaced depending on whether it's 5-year or probably 15-year, and you get to take it over that period of time. So you're still getting 100% of what you are entitled to. It's just the timing of getting that. Because it was still viable to do cost segregation when we had no bonus depreciation. And before we had 100% in September of 17, it was down to 50% at that time. So it hasn't gone away for a long time. It's just the percentages change from year to year, and they'll be dropping 20% each year, but that's dropping 20% of the bonus, not being able to expedite it.
Got it. Okay. And last question, can you walk us through some of how your most creative clients have been utilizing cost seg legally?
Yeah. Let's see, which one should I start with? I like the example of the young guy who was planning to get married and wanted to build equity. And he took a house that he bought and made a living quarters in the basement for himself. We were able to cost seg the rest of the building as a short-term rental, the rest of the house. So he was making money on that. And a few months after we did the cost seg on that, he ended up getting married. And they bought their own place. And then the entire house that he had purchased originally became a short-term rental. So that was a young man who was very sharp and understood how to leverage this. But most people don't even know that you can leverage a private single-family home with cost segregation if it's a rental property. And that was one of them. Another aspect is the tangible property regulations, which that is a whole category in itself. It's under cost segregation. But what it is, instead of looking forward, you're looking backwards at the depreciation schedule. Because as of 2014, many of the things that were capitalized in previous years can be expensed now. But it takes some knowledge of the value of what was done in those previous years to be able to separate out what has to be capitalized, what can you expense. And I did a chain of fast food restaurants here recently where cost seg wasn't an issue. It was looking at tangible property regulations of what they had put on their depreciation schedule from years back. He was able to take $1 million, actually it was over $1 million in tax actually was expensed $1 million from his need to pay taxes on it. That's a lot of money.
Mm-hmm.
So not knowing that you can look backwards, and actually those regulations are required, but most CPAs can't do it. It's a very, very calculation intense procedure to do the tangible property regulations. And you probably need to have quite a bit of those those repairs done over a period of time, like a restaurant would, to be able to really take advantage of that.
So just so I'm understanding that correctly, you can basically prorate past things that you missed. Is that what you're getting at? Okay, cool.
Yeah. See, in the past, before 2014, a lot of people made renovations, and well, even after that, they've done a lot of major renovations that never really hit their depreciation schedule. Okay, so it was just put on there as maybe a depreciation, but over 27 and a half or 39 years. Well, a lot of what was put on there as 27 and a half or 39 years are actually items you can expense rather than have to depreciate for 27 and a half or 39 years. If you won the lottery, wouldn't you want it now?
Yeah, that's interesting. Oh, okay.
Okay.
Oh my gosh. So if someone won the lottery and they didn't claim all those cost seg in the past, they can basically take it back from the past and apply it to the future.
Yeah.
That's amazing. You're like a time traveler. Tax time traveler. So yeah, I think that drives the point home that people should be very meticulous in their record keeping and going back years, so that if you do bring a cost seg expert on board, they have more information to work with. And the more information they give you, Bonnie, the better your consultation and assessment for them.
Yes, because a lot of, or I would say most of the CPAs and tax professionals out there will put one entry on a depreciation schedule that says improvements. Doesn't tell me what it is. Did they replace the entire roof down to the studs? Did they just replace shingles? Did they do plumbing repair or replace all the plumbing in the house? That makes the difference between, what can be expensed and what has to be capitalized. So there are many opportunities that are being missed, but I can't blame a CPA or a tax professional. They are so overwhelmed right now that sometimes they aren't even taking new clients. And when it comes to a specialty area like real estate, that's even tougher.
I like that. Yeah. So you're basically, in the event of an audit, you're helping people cover their butts. That's just to make sure, like, what does this line item mean? You're like, well, here it is. Here's a list. I think, yeah. All right. Amazing. I think we're at time, right, Anita? So thank you so much, Bonnie, for all the amazing advice and entertaining some of my unhinged make-believe scenarios for potential cost segregation opportunities. Bonnie, for those of our listeners that are looking to do a cost seg, how can they find you?
Well, they can either give me a call to my office number is 720-504-5776. Again, that's 720-504-5776. Or they can reach me on my email at Bonnie, BONNIE, G as in girl, K as in kilo, at cost segregation services.com.
Amazing. Thank you. And guys, we will put all of Bonnie's contact information in the episode description as well. So thank you so much, Bonnie, for joining us. This was very educational. It was like a 101 class on cost seg, but I think there were some advanced topics in there too. So it was like we took a CPE course.
Thank you, Bonnie.
You're quite welcome.
Thanks, Bonnie.
I appreciate being on your podcast. Thank you so much, and I hope it was valuable to your listeners.
Okay. Thank you.
Thank you.
Thanks for listening. But before you go, we've got a quick subtle Asian real estate update for you. Want to learn how to invest in real estate but don't know where to start? Then be sure to check out SARE's 30-Day to Buy a Home Challenge webinar series, where we teach you how to get from 0 to 1 on your first or next property. Our 6-part series begins airing on December 6th on Facebook Live and YouTube. Let's ring in the new year with your new house. Happy buying!
Thanks for hanging with the SARE ladies. Until next time, bye!